Okay, so this is my forecast. It's not trading advice. I think we'll have a V-shaped year for euro dollar, a small drop and then a bigger rise. More suffering in the first half, so perhaps a drop under the March 2015 low of 104.60, and then a virtuous rise to 120 or even 125. Let's see if I'm right or wrong at the end of the year. I think it's going to be a bit different. Monetary policy divergence does not last forever. Okay. Yeah, I'm continuing to the pound, very related to the Eurozone. We had in the past, not so distant past, strong growth in the UK, but now I believe the thrill is gone. Wages are flattening, as the Bank of England said. Growth is slower than we had beforehand. And the Bank of England is hesitant about hiking. I was talking many times also in this show that the Bank of England is set to raise rates immediately or soon after the Fed. I think now I changed my mind. I see there's a big gap. Markets are pricing in a hike from the Bank of England only in 2017. It might still come in 2016 if things improve, but there's a clear lag between the pound, between what's going on in the UK and the United States. In addition, we have a risk in the United Kingdom of this EU referendum. There's no set date, but David Cameron and the British Prime Minister will probably hold a referendum in 2016 to get rid of this promise he made a few years ago and not push it into 2017 and have more risks. Of course, he wants to stay in. It's better for the business community, which donate to his party. I think most Brits do want to stay in for various reasons. So we have uncertainty from that and uncertainty from the Eurozone, the main trading partner of the UK. Also here, I believe we'll have a sort of a V-shape, also here in pound dollar. Once the referendum is over, once we have, I believe, a small majority, like in Scotland, to stay in the European Union, things could get better. No more uncertainty, no changes. Also, the Eurozone, as I believe, will improve later in the year, so things could get better in the second half. Assuming the Fed continues hiking and the world doesn't collapse, we'll have the Bank of England later in the year talking more about imminent action, about raising rates, and that could strengthen the pound. So I believe we'll have more pressure on the pound. We haven't seen the bottom yet in pound dollar. We're at the 146 handle at the moment. I think we can move a bit lower, but not much lower, not to the post-crisis low of 135, and then we could have a rise back up, okay? Not as virtuous as I see it for the euro, but I do see a recovery over there, okay? Let's move on to the Canadian dollar and then to China. Canadian dollar, I don't know how many of you are trading it, but at least on Forex Crunch, I have live readers interested in that. And it had, when dollar CAD rose 18% in 2015, and 2016 is seeing another rise for dollar CAD. So we're seeing a weaker, but not all is bad in Canada. Why? First of all, as I said about the Eurozone, a long period of a weaker Canadian dollar is good for the economy. Not all the economy is about oil, okay? So Canada and the United States share a very long border and lots of trade. Lots of US demand fuels the Canadian economy. So if we have a more favorable exchange rate, we have more US demand for cheap Canadian goods, okay? This auto industry and other places as well. Employment situation, another good thing. Employment situation in Canada is also positive, okay? At least for now. The bad things in Canada, well, oil, and oil. And the Bank of Canada, Stephen Pelosi, opened the door to cutting the interest rate down to minus 0.5%, okay? Currently, it's at plus 0.5. We thought the lower limit that Mark Carney, Canadian, currently the governor of the BOE, said it would fall to, his lower limit was 0.25. And of course, zero has been seen as the lower limit, but the Bank of England, the Bank of Canada is ready to go negative, okay? The ugly, and the unknown a bit about the Canadian economy is the housing bubbles in the beautiful city here of Vancouver in the picture above, and also in Toronto, the biggest city in Canada. So my verdict forecast for the Canadian dollar is that dollar CAD can continue higher, and for CAD this could be an L. It could be a bigger fall. It means 150 or 155 for dollar CAD, and then stable. Not a recovery for the Canadian dollar, but at least the bleeding could stop later in the year, assuming that the US dollar stops rising. Then the Canadian dollar could catch some breath. Okay, let's now move to China, the world's second largest economy. For a few years, it's trying to make this kind of landing. It's trying to transition from investment in manufacturing to being the sort of factory of the world and building infrastructure to more services and consumption. Services, of course, India is now experiencing a boom, growing faster than China because it's exporting services, going in the path of the West. And they're looking more to internal consumption. Okay, there's wages are rising, there's more bigger middle class in China, and looking to more consumption. But it's a very, very long road. Another factor taken into consideration, there's going to be more uncertainty about China. Why? Nobody really believes the Chinese GDP figures that they publish very early every quarter, and they seem to be made up of thin air. But there were other measures to know how fast the economy is growing or how slow, looking at electricity, at rail cargo, at imports and exports, things like that. But if it's services that consume less electricity and no cargo, it's much harder to measure. So we're going to have more uncertainty. I would look at the Chinese yuan, also known as the RMB, the renminbi, and pollution. Okay, if we have less pollution in Beijing, something the authorities are very sensitive about, it also means that there's less manufacturing. And for the and I'll explain about the Chinese yuan. A weaker Chinese yuan, which we are seeing in recent days, a lower value for the yuan against the dollar, and it reflects to a weaker value against the rivals in Asia, the Japanese, and against the euro. That a weaker yuan means that transition from manufacturing to services is not going so well. It means that China is still dependent on manufacturing. But it's not exactly what China wants, because then there's danger of faster outflows, not only from the stock market, which is relatively small in comparison to Western countries, but also out of further investments. So they would prefer a more stable yuan. It also means trouble for the Australian dollar and Japan. For the Australian dollar, it means, for the Australian economy, it means sort of that China is still in trouble. And for Japan, it means that there is more competition. If we do have a stronger yuan, then it's better for China and for the whole world. It means that the transition is going well. Okay. Now, yeah, let's move to Japan, from China to Japan. The Bank of Japan is sensitive to the yen against the dollar. Each time the yen strengthens too much, the Bank of Japan, and also the government, they open their mouth and begin complaining. And of course, it raises the chances of them intervening. They would not like to intervene. They would like others to do their work for them, I guess, like everybody, right? In 2016, I believe they'll be perhaps a bit less focused on dollar yen and a bit more focused on their rivals in Asia, against the Chinese yuan, especially with recent movements. Again, they don't want to act, they want others to do their work. I think that the range between 115 and 125 that we've seen in 2015 is their preferred range for the Bank of Japan. They don't want the yen to weaken too much. It'll make imports too expensive, and it'll make everything unstable. We had a big weakening in the yuan, and now things are sort of in the right range. But if dollar yen falls under 115, it could trigger action, at least verbal action. Okay? Yet again, they prefer to talk and not to act. Also note lower oil prices. If oil prices continue staying at lower levels, it can allow for a lower yen, because Japan relies on imports of energy, imports of oil. But I think they'll be more sensitive to the exchange rate against the dollar and against the yuan. More considerations to look out for in Japan in 2016. Here's a picture of the guy who's sitting is Kuroda, the Bank of Japan's governor, and the guy standing up is Shinzo Abe, the prime minister. The government is expected to raise the sales tax once again. Officially, I don't think it'll happen because they had a sort of big blow from raising the tax rate back in 2014. It pushed Japan into recession. We have elections probably to the upper house of parliament in July, probably. There's no set date, but it's expected that Shinzo Abe, the prime minister, the LDP party, will maintain the majority in also in the upper house. If they reach a two-thirds majority, they could also change the constitution, but constitutional changes could happen only in 2017, and we don't know the impact. So this political event in Japan, I believe, will not impact the yen too much. Okay, let's move to the Australian dollar, from also staying in Asia Pacific. The Australian economy is holding up relatively well. The employment situation looks really good. It seems that Australia is getting over China, less dependent on China, but the Australian dollar is still impacted a lot from China, even if the economy is not is less sensitive. Lower Aussie dollar for longer that we had in 2015 is supporting the economy, like the Canadian dollar for Canada and like the euro in the Eurozone. And I believe that China will not let itself collapse. The demand from China to Australian commodities will still remain pretty healthy. Not huge growth, nothing spectacular, but good enough. But we have to look at commodity prices. They're not going anywhere fast. They're still falling. And the RBA has more room to cut. So the interest rate has stabilized at 2%, but 2% is above zero. We still have room to cut. Not in the next few months, but perhaps later on if things get worse. And this threat of RBA action is also sort of could have an impact. Also in Australia, another thing to watch out for is here we have a nice picture of the Sydney Harbour. Prices also, like in Canada, prices in Sydney and also the prices of homes may be too high. Okay, but if the RBA does macroprudential policy, that means limiting loans for mortgages, it could be a substitute for rate moves. Okay, if we have sort of the RBA tackling house prices with loan limits, it means less rate hikes. Less rate cut. No, sorry, less. That means they don't have to raise the rates, right, to fight house prices. That means they can let the Australian dollar down. So we should watch out for regulatory action also there. We had some of this in 2015, and we could have more in 2016. Of course, Chinese demand is also important for the Australian economy. And another sort of factor, if you want to look for correlation, it's still the price of copper. So the Australian economy is less dependent on China and commodities than it used to be. But for the Australian dollar, not only for the economy, commodity prices have a big impact. I foresee a turbulent year for the Aussie dollar, but I can't point out a clear direction at the moment. We have sort of mixed signs over there. Currently, the Australian dollar is tumbling down because of this risk-off atmosphere, because worries about China. I believe the worries and the moves are a bit exaggerated, but it doesn't mean a rise in the Aussie dollar. I think it's going to be mixed. Kiwi, less dependency on food. Sorry, they're dependent still on food, and I think it's positive. Here we have a picture of some cows in New Zealand. Really beautiful landscapes over there. The RBNZ recently, the Reserve Bank in New Zealand, said they're sort of not expected to cut rates once again because they reached sort of the lower limit, 2.5%. The economy in general is doing well, not only because of milk prices, even though they fell yesterday, they remain a good source, milk, dairy products, good source for the economy. They did manage to, at least for now, contain excessive house price rises in Auckland, and unemployment is low. I think they'll have, the Kiwi dollar could have a positive year, especially against the Australian dollar. And let's see how that turns out. In the first half of 2016, I believe Kiwi dollar will depend more on the US dollar. In the second half, the RBNZ could act if the situation in the global economy worsens. We could have, and the Kiwi strengthens too much, we could have the RBNZ cutting rates to weaken the Kiwi dollar and to mitigate slowdown. But all in all, I do see a stronger Kiwi dollar in 2016, but this could be limited. We could reach this glass ceiling pictured below. Okay, so that's for the Kiwi. Don't know how many of you are trading it. I focused more, of course, on the US dollar and the euro more than currencies like the Kiwi. Okay, we have a few more minutes. Let's run fast on other events. I think Saudi Arabia is already a big story in 2016 with this clash with Iran, and it'll continue being a story throughout the year. Saudi Arabia, the huge oil exporter and producer, is in trouble due to low oil prices for too long, an oppressive regime. I think it's worse than Iran, for example, that is sort of the enemy. They're embroiled in a war in Yemen, their southern neighbor, with all the insurgency over there, and with ISIS. Some blame the Saudi regime for some collaboration with ISIS. Anyway, they're also in trouble because of the war in Syria. They now have less friends in the US. US and Saudi Arabia are long-time allies, but with less dependency of the US on Saudi Arabia, and with the more oppressive regime and more criticism, they're sort of have less friends in the United States and less friends in OPEC. We've seen how in late 2014, Saudi Arabia decided on its own to keep on producing high amounts of oil and angered OPEC members. So lots of trouble for Saudi Arabia. The Saudi rial, the currency there, it's pegged to the US dollar, and it's in danger as well. That means because of low oil prices, maybe they'll have to devalue the Saudi rial to have more income in US dollars to support their spending, okay? And this could, of course, also create more turbulence. A weaker Saudi Arabia, I don't see a collapse of the regime, but who knows? But a weaker Saudi Arabia has implications for the whole Middle East. It could steer more turbulence. If we have clashes in the Middle East in general, and we've seen this tension now with Iran, it could push oil prices higher. Perhaps this recent crisis with Iran is helpful for both countries and other oil producers to lift oil prices. But in general, it's not good if we have trouble in the Middle East. It could have ramifications elsewhere. We've seen how the crisis in Syria has implications for Europe in terms of refugees and other impacts. So that's something to watch out for. Russia, similar to Saudi Arabia, colder weather, but trouble due to low oil prices for too long, oppressive regime, interventions in Syria recently and beforehand in the Ukraine. And the world cares a bit less about Russia than it did last year, because we at the West have a very weak attention span, and no news from Ukraine is no news, even though the Russians are still there. But in Russia, we have high inflation because of the weak ruble. Discontent, it's still brewing there because of a worsening economic situation, a recession, and low oil prices. It could lead Putin, in the picture here, to more adventures in the Middle East, and that could be a risk for oil. So that's another factor to watch out for. Russia is not a big economy, but it has a lot of political weight. Okay, and quickly let's talk about bonds and stocks. Bonds first and foremost depend on the Fed. More Fed hikes, lower lower value of bonds, higher yields. Okay, yields could continue rising initially with higher inflation, with the base effects moving away, and with the hikes, but then it could drop back down. Stocks depend a lot on QE. That means I see a better future for stocks in 2016 in the Eurozone because of more printing and less so in the US. Company profits are relatively high in the United States, but lots of these profits come from stock buybacks, all kinds of financial engineering, tax avoidance, things like that. I'm making a huge generalizations, of course, not, but they'll have to produce more stuff, manufacture more stuff, and not only make buybacks. So I don't think we'll have this Wall Street panic here in the picture from 1929. But I also don't know. I can't see unless we have more QE. It's hard to see, or I mean, more. I think central banks. A lot still depends on central banks, and if the Fed really continues hiking, and companies don't make profits from selling stuff, I believe stock markets could fall, which is good for the Japanese yen as a safe haven, and a bit more for the euro and the dollar, but it depends on the timing. So that's sort of very, very brief note on bonds and stocks. Okay, I've